Hello, welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Scott Hazlett. Scott is an attorney and a CPA, and he's headquartered in Lafayette, California. He practices in the area of taxation and estate planning, financial problem resolutions, and 1031 exchanges. He's a certified specialist in taxation law under the California State Bar Board of Legal Specialization, and he's also a qualified intermediary for tax-deferred exchanges. In his past life, Scott worked with Price Waterhouse and was an investment executive with Merrill Lynch. He graduated from Taft University School of Law in 1996 and set up his own law firm. Are you a past president now?
I was.
Okay, so you were the president of the East Bay chapter, California Society of CPAs. And in the past, also, he was a sports writer. He covered Major League Baseball, National Football League, and other sports. So, Scott, welcome to the show.
Thanks for having me. Appreciate it.
Yeah, well, it's a pleasure to have you as a guest. So, Scott's one of my people I like to have when we're talking about special real estate topics. And so today we're going to actually be talking about the subject of real estate professionals and passive losses. And if that sounds kind of confusing, wait till we get into it. But anyway, it's a subject I've been getting more questions about recently, and that's why I decided to have it as a topic. Now, related to this, people who are real estate investors, I want you to know there's a couple of IRS publications you should get. So there's publication 527, which is residential rental property, and there's another publication, 925, passive activity and at-risk rules. These are both at the IRS website, which is www.irs.gov, and you can get them free. And there's some good information there that you can refer to. And before we get started, as I usually do, I want to caution our viewers that we're talking about a very complex subject, and we want our viewers to get help from a competent tax advisor. So this is part of a conversation we hope that will be a continuing one with your own advisor about your own circumstances. So Scott, with that, let's get started with some questions.
All right.
First question. Why would someone want to qualify as a real estate professional?
Well, so I think it's fair to take a step back and a little backdrop, a little historical perspective on this, and then get into this notion of tax fairness and how this all came about.
Tax fairness? What the hell is that?
Tax fairness. somebody said that fair market value is the only point when the word fair appears in the tax code, and I agree with that. But what happened in the late 70s and early 80s, we had these things called so-called tax shelters, and what was happening was that people would make an investment of little or no money, perhaps, and they would take on loans to buy investment real estate, commercial real estate, rental properties, whatever the case may be. And through the magic of accounting, shall we say, and leverage in buying this investment real estate, the real estate itself would trigger a bunch of losses that could be used on a tax form. So you might actually have let's say you had a tax outlay of $100,000, and in the first year you had a deduction for $100,000 or $50,000, and the tax rates were really high then, much higher than they are now. And so you'd make a real estate investment, and you'd get really what amounted to a large subsidy from the federal government in the form of a tax reduction on your Form 1040.
Right.
So Congress, so that went on through the mid-'80s, and in 1986, Congress saw that as an abuse and enacted something called the Tax Reform Act of '86, in which the passive activity loss limitation rules were adopted. And generally speaking, what that meant was that if you had these types of losses, which up to that point, a loss from this kind of thing could offset wages or business income and so forth. Now these 86 rules said no more. If you have these losses, you cannot use them to reduce your wages or reduce your other business income and that kind of thing, with a myriad of exceptions and limitations, exclusions, etc. In the 10 years following, real estate people brokers, developers, leasing agents, people that own investment real estate, they complained. They said everybody in America who's in business can have a loss and deduct it against other income. So let's say I'm a plumber and I have a plumbing business and I have a miserable year and my expenses exceed my deductions, and so I have a loss, and my wife has a day job, and so we can take my plumbing loss against her wages. Well, why shouldn't a real estate investor who makes an honest investment in real estate have that same rule? And so developed was this compromise. I think it was about 1993 when this came into effect. And it said basically, if you are a real estate professional, which we'll talk about, then the general rule of losses don't offset wages will not apply to you. And in fact, if I was a real estate investor and I had a bunch of losses, and my wife was a doctor, let's say, and she made a couple $100,000 doing her job, my losses could offset her income, which would be true for a real estate professional in certain circumstances that we're going to talk about.
Right.
So that's the background of this type of situation.
Right. And so what it boils down to is, if someone would want to qualify, is when you are a real estate professional under this exception, you are able to use your losses from your real estate operations as a deduction against other income.
Right. So let's take a real world example of what's happened in recent years. And of course the bubble has happened and we're all upside down in our real estate, and that's a different program. But let me give you a quick case study. So my client goes out and takes a loan against their house because they were giving loans away against their personal home, and they go out to Phoenix, Arizona, and they buy 3 or 4 duplexes, and they have a little real estate empire going in Phoenix, Arizona. But it was highly leveraged and so forth. And when you figured out the depreciation and all the deductions and so forth, they really lost money. Let's say they had 4 properties, they lost $10,000 each. This was not a real estate person. This was, let's say, a lawyer working. It was an employment lawyer or something, making $200,000 a year on a day job, committing little or no time to this. It really was a sideline, if anything. So the common perception for those not informed, unaware of these passive activity rules, well, I've got $40,000 in losses. That'll just offset against my $200,000 in wages. Well, that was true before '86,
right,
but certainly not now. So then change that around a bit and say, if the lawyer's wife is a full-time real estate agent who is considered a real estate professional, or she's a real estate developer, or she's some other trade or business that's defined by the tax code as a real estate professional, that in that situation it's conceivable, and subject to some other tests, it's conceivable that they could take those losses against the husband's wages, even though he's not the real estate professional. So that's one of the reasons why you'd want to have this designation as a real estate professional.
Right. Okay. Now, do both a husband and a wife have to qualify when they, like file a joint return? Do they both have to be a real estate professional to get the benefit of this rule?
No, the immediately preceding example is a perfect case. There's an employment lawyer, has nothing to do with real estate. He's grinding away on his job, underpaid at $200,000 a year. Oh. That's I know, we should have the violin music, right? Mm-hmm. So the wife works as a real estate professional, and if they're married filing jointly, then they will qualify as joint filers.
Yes. Okay. Now, do the same rules apply for both federal and state tax reporting?
Great question. So these rules were adopted under something called Federal Internal Revenue Tax Code 469C7. The state, generally speaking, the state conforms. A lot of the state rules will just dovetail the federal rules. This is one case where there's nonconformity. So if in my example you had a $40,000 loss that this hypothetical married couple could take on their federal return, they will actually have a difference on their state return. So they'll have a $200 income, but they won't have the offsetting loss, the $40,000 loss.
Right. So some of our viewers may not live in California. That's one of the reasons why you need to see your tax professional, because some states have conformed, some have not. California has not conformed.
Correct.
And what it means is that how you even report the income may be quite different on your federal income tax return and on your California income tax return.
Correct.
Yeah. Okay, well, let's see what we have next. Do real estate professionals report rental real estate operations differently from other taxpayers?
No, and let's take a real simple example. So we got this fourplex It has rental income, it has insurance expense, property taxes, maintenance, management, other fees, this type of thing, utilities, cleaning, whatever, mortgage interest. Those will all be reported for an individual owner on Schedule E, page 1. And there's a list, there's an income line, and then there's a list of deductions, and then there's a depreciation expense, etc. And so let's say the aggregate, the net of all that, is a loss of $10,000. In general, under the 86 rules for someone who's not a real estate professional, the $10,000 will be suspended, meaning it will be shown on the form, but it won't be deductible immediately, but it'll be carried over to the following year and maybe used next year or maybe used many years from now, depending on the facts in those years. Now, for the real estate professional, you go through the same exercise, your rental income, deductions, depreciation, etc. But when you come down to the bottom line, instead of saying what's allowable, nothing, the $10,000 loss would be allowable. That carries over to page 1. It can offset interest, dividends, wages, and those types of things.
Okay. So actually in the instructions, anyway, it says that you should put on Schedule C.
well, possibly. It depends on whether the activity itself is the real estate professional activity, like the development, that kind of stuff. But the supplemental income, if it's a rental property, that might not be the case.
Well, they seem to imply that it may even be subject, if you have income, to self-employment tax, which that's further the reason
that gets into a whole kettle of fish.
A whole kettle of fish. Okay, well anyway, just wanted to bring that up as something to talk about with your tax return preparer again. Now, let's get into some of the nitty-gritty. What requirements have to be met in order to qualify as a real estate professional?
Okay, so there's really basically two tests. There's a test of the taxpayer, and there's a test of the activity. And it's possible, actually, for someone to be a real estate professional and have a rental activity, for example, that does not qualify for this special treatment. So the first test is the taxpayer, which in the case of married couple, either one, is the taxpayer a real estate professional? So it depends on what kind of job they do. So you have this nice list: development, redevelopment, construction, acquiring, converting, renting, leasing, operating, and then real estate broker, which you've written a star on it, may or may not qualify depending.
Well, the big question is, it says specifically broker in the Internal Revenue Code. There's some real estate agents that have been claiming the exception.
Right.
And then some of the courts have been saying, yeah, we think that a real estate agent is covered.
Yes, I would agree with that. So whether it's a real estate agent working for a company or a real estate broker independently, it's probably the same thing. It's probably qualified. So that's the first thing. Do you do that kind of a job? Second, in that job, is it a job that you spend more than half of your professional time? So if you work 3,000 hours a year, for example, do you spend 1,500 hours doing that and then 1,500 hours or less doing dog grooming or lawyering or whatever the case may be? And then the last test is the time spent in the activity, the real estate professional's activity, is that 750 hours in a year.
Right.
And once you achieve those factors, you are considered a real estate professional.
Yes.
Now the next test is for each activity. So let's say you had 4 rental properties, and there's the instructions that you have there, and the publications and the code and the regs and so forth. I like to refer to, and I think you find it at page 4 of the instructions on a form called 8582. And 8582 says, here's how you compute these losses, whether they're applicable this year, whether they're not. The rules are a myriad of rules not discussed today, but there is a formula. There's a number of formula whether something is deductible or not. Well, in those rules, they define what is considered an activity that has the material participation of the taxpayer. And I believe there's about 8 or 9 different tests. There's things like, are you the only person that is the active participant on this activity, or do you sub it out to a manager? Do you spend 500 hours on this activity? Do you, 5 out of the last 10 years, was this considered material participation? So maybe you can squeeze in that way. I'm not going to sit here and cite the list because I don't have it committed to memory, but the point is that there is a list, and there's an argument, if you qualify at least under one of those, that an activity might be an activity that would qualify this. Yes, non-passive. So let me beat that to death a little bit more. So let's say there's a real estate developer who is clearly greater than 750 hours, greater than half the time. And they're clearly a real estate professional. And let's say they have 2 rental properties in addition to their development business. One of the rental properties is a mile from their house. It's a single family home, and they rent it out, and they do all the work related to it. There's no other person. They don't hire a manager. They don't have any, they just literally, they do all the work, all the maintenance, all the tenant relations, the leasing, all the nonsense. Tenants and toilets, sometimes people call it, okay? And a second rental property they have 1,000 miles away in a different state, and it's not just feasible really for them to manage that one because it's so far away and so forth. So they hire a manager for that one, and the property manager takes care of the tenants and takes care of the property and so forth. In that example, generally, absent some other facts that I don't know about, the nearby property would be considered not passive. In other words, if they had a loss from that, they could trigger it. But the one 1,000 miles away, even though they're a real estate professional, would be considered passive activity because they're not, that's not a material participation activity. So,
okay. So there's, as I understand it, there's a 750-hour test that we're dealing with here. More than 750 hours of services during the tax year in real property trades or businesses in which the taxpayer materially participates. So one of the questions really that I have related to that is, if somebody has another job, isn't that pretty hard to do?
yes, absolutely. In fact, if you look at the audit manual, the IRS, if someone is audited on this, there's actually a particular line on page 2 of Schedule E. It's called the reconciliation line for real estate professionals. So if there's a number in that box, it's a flag that this taxpayer is taking the opinion that they are a real estate professional. Now, one thing I want to say is it's not an election. If you are a real estate professional and an activity is material participation activity, you have to take the loss. You can't elect to not take it. It's not an election. But presuming it does apply, now you've got this number in a box in a specific place on the form. So it wouldn't be very hard for the IRS computers to say, pick out all of the forms that have a number in that box. And then they go back to the taxpayer and they say, okay, well, prove it to me. And with the burden of proof on the taxpayer.
Right. And that's sort of what's